Hello and welcome to the
The
Lawn Only
Lawn Only
Podcast.
Podcast.
Episode we're basically doing like prestige cable television, and we're releasing according to our own schedule. And so sometimes it's 3.5 years between seasons, sometimes it's 2 weeks. It's kind of like Breaking Bad had two. Its last season was actually like episodes 6 and 7 were separated by 6 months or something like that. I don't know.
Or that Doug just informed me that there was actually an Equalizer series like currently going on as well as in the past, and all I knew about was the movies with Denzel.
Yes, I had to inform my elder boss that the first Equalizer was not Denzel Washington.
Yeah, I didn't know that.
The first
I
Equalizer
might
was
have
on.
known that, but I forgot because I never watched it anyway. So,
I didn't either, but I mean, when I was watching Newhart with my parents, I'd see a commercial for the Equalizer. So
well, I think I watched Newhart occasionally, but you being the pop culture aficionado that you are, I mean, I will never be able to keep up with you on that stuff.
I'm riding on fumes now because I'm not as up to date with things as I used to be, just because there's just so much content,
And so much nonsense.
and that's true too.
Yes,
So we are going to discuss interest rates and inflation.
we are. One segment.
One segment. That's it. We've
That's
been
it.
away for a few weeks. When we have something to say, we're going to say it. If we don't, we might not say anything. We're not going to fill time. We're doing this primarily for our clients. If anyone else wants to get on board, we'd love to have you. TaylorFrigon.com. Learn about us. Learn our mutual fund. Learn about our mutual fund. We can service people of all ages, sizes, and wealths, and we would be happy to discuss it with you. And you can also get our mutual fund on many different platforms. A lot of the big discount brokerages have access to the Taylor Frigon Mutual Fund, TFCGX. So we'd love to talk to you, but you actually can invest with us without having to talk to us.
What a deal.
What a deal.
Interest rates and inflation.
Yes.
So, we've been in the camp of saying that we think that rates are coming down, and I think they will. Ultimately, there's this consternation going on in the market right now over still more higher for longer. The inflation headlines have been a little stubborn in the last 2 or 3 months. That's giving the Fed pause, all of which is in some ways nonsense. But I think what we have, what we're thinking now, and what we're really actually in many ways hoping will happen is that it doesn't require. It's not hoping will happen. That's terrible. What we think will happen is that you will see continued growth and continued movement back towards what commonly is referred to as risk assets or growth-oriented investments without having to have lower interest rates. And the meme in the last couple of years has been interest rates up, inflation up, growth investments bad, down, crushed, slaughtered in many cases, particularly the smaller of the small companies, the microcap type companies. At what 5.25% to 5.5% Fed funds rate target that the Fed is at right now, the reality is that is not so far outside the realm of reason that the economy and companies can't ultimately adjust. And the longer that this goes on, the more likely it is that they make adjustments. Their customers of companies make adjustments. Their customers make adjustments. And a case in point, one of the stories we've heard a lot lately from companies that rely on capital markets purchases, or excuse me, not capital markets, capital equipment purchases in their business model. So say, for example, a medical device company that has what we would call a razor and razor blade model, where they sell the razor as a capital equipment purchase to an end customer. And then they will sell razor blades on an ongoing basis. So there's a combination of a manufacturing operation that's selling a product and then an ongoing recurring revenue stream that comes from the razor blade. In many instances with companies that have a model like that, is that the capital purchase side of their equation has been muted, to say the least, and in some cases really hurt because of higher interest rates, because oftentimes in the end customer that they're selling their capital equipment to is financing that and is now paying a much higher cost to finance that purchase. And so as a result, those purchases have slowed. Ultimately, the longer that these rates stay higher, those companies, those end customers adjust their business. They're increasing their prices to their end customer, and making adjustments that way. And ultimately, I mean, if you think of it just in a purely logical sense, these businesses have to stay in business. This is what they do. They can't go on forever and ever not making further equipment purchases, or else they'll go out of business. So they're going to make adjustments on their pricing. That works its way through the system, and eventually it gets back to an adjustment to the current reality of what interest rates are. Go back to the 80s and 90s, where interest rates were much higher than they are right now, and the economy did very, very well. I think the Fed may well be making a mistake with respect to staying higher, because they are they are at risk of slowing the economy, or even causing a recession in the economy that they don't necessarily want to have happen. But that's not baked in the cake for sure. I do think ultimately they will, probably because they will be scared by some negative quarter GDP growth, 2 or 3 or 4, however many quarters out, and they'll panic and they'll start lowering rates. And what we don't want to see, because we spent certainly the better part of 15 years, if not even going back to the early 2000s, when they stayed at 1% for too long, then they stayed at 0% for too long. I mean, how many years were we complaining about the fact that 0% interest rates were not healthy? This is why it's not healthy. The fastest increase in rates and inflation that we've seen since the 70s really threw a wrench in all kinds of things, the pricing of all kinds of assets. And we're living through the reason why we thought 0% interest rates was a distortion. The last thing in the world we want to see is them going back to something like that. But I would not put it past them. That said, I'm starting to warm up to the fact that, as much as I don't like what the whole Fed thing stands for, they seem to be trying to stand pat, not create the problem of the 70s, where they went back to reducing rates too soon, and the darn inflation bug was really difficult to beat. Again, all I will say on that is, I think we put too much emphasis on that. We put too much emphasis on the Fed's involvement. They put too much emphasis on their own involvement. What's really causing economic stagnation right now is way too much spending from government. I mean, if you look at the employment numbers, for example, the only reason employment is holding up is the government keeps hiring people. They're spending like crazy, and that's crowding out the investment in the capital market, in the financial, private financial markets. And private.
Well, someone needs to prosecute all these lawsuits against people who question the 2020 election, Gerry. So
you're getting into politics now. We're going to stay out of that for now. But I think it's important to point out that there does seem to be, we hinted at this earlier in the year, but we thought it might be a little bit more related to the expectation for lower rates, and it was. But we think now the transition is continuing, but more so because of maybe an acceptance that the longer rates and stay where it's at, and inflation will start to work its way down. I don't think we're going to see deflation of any significance. In fact, we would see what I'd call good deflation, which is lower pricing because of greater productivity, had we not were we not seeing such a crowding out of the private sector from government spending. People forget that one of the great, we used to talk about, through the late 80s and into the 90s, this deflationary boom concept. What that was, it's a little, using semantics, because you usually think of deflation and inflation from a monetary perspective. It's a monetary phenomenon, but the deflationary boom, what that was lower prices because of increased productivity. Technology was helping businesses to be more productive. There's a big wave of that sitting out there waiting to happen. The problem is that we've just had this crowding out of public investment instead of private investment. Or funds are being spent by the government, and they always spend money inefficiently. I don't care what anybody says. There's nothing you can argue that, maybe short of financing wars, which certainly we wish they weren't doing,
Gerry, getting political.
Okay, but
It's hard
short of
not
that,
to
there's not a
cross
whole
the
lot the
street.
government can do efficiently. I mean, and I'm not sure they do that efficiently, but who else is going to do it? I
They
guess
do it well, but not efficiently.
sometimes,
Well, I
not
mean,
always.
when I mean well, I mean in volume.
They do
So
it voluminously.
voluminously, yes.
So the main message is we have not seen. We've had a little bit of a correction, 5 to 10% here. It's starting to recover now in the last few days, but over the last 3 weeks or so, April pretty much. And we did notice, and in fact, in our own investment committee discussions each day, our group has noticed that, if some of this news about higher for longer and inflation were hitting us, if this were last year and we were hearing this, and for that matter, it was happening, things would be down 5, 6, 7% in a day. We were getting these 1, maybe 2% downs in the growth assets, and it just didn't bite as hard. And I think that's part of this kind of transition to an acceptance and a getting accustomed to what I would call a higher term structure for interest rates. Term structure meaning, across all of the maturities. And there is still inversions, as they say, higher rates, or short-term security, short-term notes versus longer-term notes in certain parts of what we would call the yield curve, but which many people argue means recession. And I think the story goes it's predicted 10 out of the last 5 recessions or something like that. But in any event,
See what he did there?
what's that?
The 10 out of the last 5 recessions.
Right.
Yeah.
Yeah.
Just making sure everyone got the joke.
Yeah. So that's it. I think that's what we wanted to get off and out into our listening public.
How much of the problem here is a matter of people conflating? There's kind of a matrix, and obviously there's more components to this matrix, but people conflating the real estate market and the capital markets, the stock markets, and investing and the stock market versus the economy. We have I'm not saying there's a perfect overlap there, but there's a lot of things seem to
There's
be
definitely not.
Yeah,
There's definitely not.
The people are kind of going for A equals B equals C equals D, and those are 4 different overlapping things. And ultimately, to think that a drop in interest rates, number one, is going to immediately stimulate the economy might be oversimplifying things. And number two, to think that it's going to immediately stimulate a quarter price drop. People are waiting for that quarter point interest rate drop. Well, I mean, if the Fed does that, I think we've seen by now, they're not going to immediately do another quarter price. It's going to take a couple of cuts for things to be substantive enough to affect people's mortgage payments. And then there's the question of those could be offset by a corresponding increase in demand for homes.
Or a lower price of homes. If you got the reverse effect, which is kind of what you're getting right now, right?
Well, now they're lower price, but if the mortgage rates go down, which people seem to be waiting for, well, guess who else is waiting for it besides you, listener? Everyone else. And so your any savings you get on your mortgage payment are in terms of are probably going to be offset by, say, interest savings are going to be offset by an increased price of your house. People are going to have to start pegging their expectations to this missed opportunity to buy into a house at a lower 4% interest rate 2.5 years ago. That's gone.
Yeah, I think your circumstance, if you're ultimately going to own a home, I wouldn't be as worried about interest rates right now as I would be just, can you find what you need and want to live in? That said, we had, I think about the first mortgage I ever had I think it was at 9%, so everything is relative to the recent history. And it's it's part of my argument of that we can absorb these interest rates. And mind you, I don't think this is going to last. I think we're likely going to be back down into the, certainly 4s, if not even mid to high 3s. And I hope that's kind of where it ends up, because to me that is The perfect circumstance would be something in that range, and then it's just left alone, and let the economy take care of itself. Get government out of the way. Get government stop spending money like crazy. And I mean, I have to say, we do have another podcast we could do because it's on all these crazy regulations that the government's throwing in. Just this week, net neutrality, from the FCC, the FTC with non-compete agreements going out the window, for as far as business is concerned. And there's more. I mean, it's just they're piling it on right now. And this stuff just needs to stop. It just needs to stop because it's not helping anybody. I mean, look at what's happening in California with the ridiculous minimum wage thing. All these fast food joints are going to automation. They're going to robots. I'll tell you what your minimum wage is. It's zero. Ruining the opportunity for young people, teenagers, getting in the workplace and learning what it is to have a job. So, maybe some of that stuff can get sorted out in the political arena, maybe not. We still get by in spite, regardless of what nonsense they do. They're making it harder, for sure. That's all part of the, whether it's government spending or government overreach, that's all part of what's helping to hold the economy back. And is why we've gone from 3% to 2% over the last 15 to 20 years or so in average GDP growth. People think that's not that much. It's a third lower. Costs people's lives in certain parts of the world.
Okay. Anything else you want to say?
Yes, but we actually have a few more podcasts than we can do. So maybe we won't be 3 weeks out this time.
We will see. We'll do it whenever we darn well please.
That's right. We don't hold to a schedule.
Yes. Listenership numbers be forgotten.
Be what it is.
Be what it is.
I don't really care.
Well,
I mean,
as I said, we care, but we
don't care. This is for the record.
We just want to get it out there.
Yep.
I can't think of anything else I didn't add. Well, I guess I would just iterate this since Gerry got a chance to talk and I only got a chance to snipe here and there. People
Doug has to talk.
I have to say something. And fortunately, the most substantive comments I've made today have been about the Equalizer. But starring Edward Woodward, which
I thought it was Queen Latifah.
Well, Edward Woodward, and then Denzel, and then finally Queen Latifah as they brought it back to TV. But I was just saying that people do need to consider their current situation and then stop this idea that the fear of missing out that they have. People had a chance to sell and buy something and lock in a lower interest rate, and they missed it. And guess what? That's what people do with real estate. And it always seems you should have bought 10 years ago when it was cheap, when it was cheaper, and then but 10 years ago you were saying it was too high and the market was going to crash. And again, we are talking about real estate. Last I checked, we're not a real estate show. I do think people are using their feelings about real estate to drive a lot of their investment decisions, and the real estate does not. What happens in the real estate market does not directly always impact the stock market. And again, you've got investing.
It's the other way around. It's the other way around. Business drives real estate. It's ridiculous the extent to which, I mean, it's not. You don't have a real estate market without having a sound economy run, with businesses flourishing. It's just a fact. Whether it's commercial or housing, it doesn't matter.
That's true. And generally speaking, I would say that's the case where you had real estate so severely and negatively impact the economy in 2008, 2009 was the anomaly, not the general rule. So,
yeah.
Well, in the meantime, you can check us out at taylorfrigon.com. Email us at longonly@taylorfrigon.com. And also we can be found on Instagram, taylorfrigon.invest when we post there. And look up our fund if you feel that might be a good choice for you at many brokerages around the country. Anything else to say, Gerry?
Nope.
All right. Until next time, I'm Doug.
I'm Gerry.
Thank you for joining us on the Long Only Podcast.